Good day, everyone. Today, we will be covering one of the most critical areas in international taxation. And here, we will be looking at transfer pricing and permanent establishment under Module 16. Our discussion will focus on how permanent establishments are defined, how they affect a company's tax liabilities, and how to ensure transfer pricing compliance for these entities. We will also walk through a series of case studies to illustrate practical application of the concept we will cover today. So, we will be discussing and focus on how permanent establishments are defined, how they affect a company's tax liabilities, and how to ensure transfer pricing compliance for these entities. So let's go through and get started. Now, definition of permanent establishment. A permanent establishment refers to a fixed place of business through which the business of an enterprise is wholly or partly carried out. This is a critical concept in international taxation because once a company has a permanent establishment in a country, the tax authorities of that country have the right to tax the profits generated by the permanent establishment. Now, let's look at the key features or key examples of a permanent establishment, or what could trigger permanent establishment. A place of management. You can look at a place of the key examples of what can trigger is a place of management, a branch, an office or a factory, a construction site or an installation project that lasts for a certain period, usually beyond 6 months, as stipulated in most double taxation agreements. Now, understanding whether your business activities create a permanent establishment in a foreign country is essential because of the significant tax implications that follow. So now let's look at the key features of a permanent establishment. Now, to determine if a business constitutes a permanent establishment in a foreign country, three essential features must be considered. Now, one is a fixed place of business. A permanent establishment must have a physical location. This could be a place of management, a branch, an office, a factory, or even a construction site. The physical presence must be geographically identifiable. Now, another key feature is duration. The existence of this fixed base or the existence of this fixed place of business must be more than temporary. Generally, this means it has to exist for more than 6 months, but the actual duration can vary based on the relevant double taxation agreement between the home country and the host country. Now, lastly, business activity. It is not enough for the enterprise to just have a presence in the country. That location must be used for conducting the enterprise's business activities. For example, a branch that engages in sales or provides services will typically be considered a permanent establishment. Now, let's look at implication of permanent establishment. Now that we understand the basic features of a permanent establishment, let us examine the implications of identifying a permanent establishment in a foreign jurisdiction. One is taxation rights. Once a PE is identified, the host country has the right to tax the income generated by the activities carried out through the permanent establishment. This means that profits derived from the business activities performed by the permanent establishment are subject to local taxation in the host country. Profit attribution. The amount of profit subject to tax in the host country depends on the functions performed, assets used, and risk assumed by the permanent establishment. Essentially, the profits must be attributed to the permanent establishment based on its actual economic contribution. Now, another thing to look at from the implication is transfer pricing. Just like in related party transactions, the pricing of transactions between the permanent establishment and the rest of the enterprise must comply with the arm's length principle. This means that any transaction between the permanent establishment and its parent company or other related entities must be priced as if it were between independent parties. Now, let's look at transfer pricing compliance for permanent establishment. One, let's look at the overview. Transfer pricing compliance for permanent establishments involves the application of the arm's length principle to transactions between permanent establishment and the rest of the multinational enterprise. This includes goods, services, intangibles, or financial transactions. The arm's length principle ensures that transactions between the permanent establishment and the other parts of the enterprise are valued in the same way as they would be if they were made between unrelated parties. Compliance with transfer pricing regulations is critical to avoid tax disputes and to ensure fair taxation between the host country where the permanent establishment is located and the home country where the parent company is headquartered. Now, steps for compliance now. Ensuring transfer pricing compliance for permanent establishment involves several crucial steps. Step 1 is functional and risk analysis. So there is a need to perform a detailed functional analysis, and based on this, the first step in determining how much profit should be attributed to the permanent establishment is conducting a functional analysis. So this involves understanding the exact activities, functions, assets, and risk associated with the permanent establishment. For example, is the permanent establishment responsible for manufacturing? Is it responsible for sales or services or service provision? This will help in determining how much profit should be attributed to the permanent establishment. We are still under functional and risk analysis, so you also need to identify the economic we also need to identify economically significant activities. The goal is to identify the value creating activities performed by the permanent establishment. For example, in a sales permanent establishment, the key activities might include marketing, customer relationship management, and concluding sales contracts. In contrast, for a manufacturing permanent establishment, the significant activities would include production, quality control, and supply chain management. Now, having done the functional and risk analysis, the second thing to do is the attribution of profits. So, the authorized OECD approach, which is AOA, is widely accepted for attributing profit to a permanent establishment. The authorized OECD approach recommends that profits be attributed to a permanent establishment based on the functions performed, assets used, and risk assumed by the permanent establishment, as though it were a distinct and separate enterprise from the rest of the company. The next thing, after you attribute profit to the permanent establishment based on its economic activities, is to use appropriate transfer pricing method. So various transfer pricing methods can be applied to determine the appropriate price for transactions between permanent establishment and other parts of the business. The choice of method depends on the nature of the permanent establishment activities and the availability of comparable data. Some common methods include comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, and profit split method. So step 3 now will be documentation requirements. Enterprise transactions involving permanent establishment must be supported by detailed transfer pricing documentation. This documentation should demonstrate compliance with the arm's length principle and justify the prices assigned to the goods or services exchanged between the permanent establishment and its parent company. Now, under the documentation requirement, you need to maintain comprehensive transfer price documentation to support the pricing of transaction between DP. Then you also need to prepare documentation similar to master file and local file. Most jurisdictions require the preparation of a master file and local file. The master file provides an overview of the global business and overall transfer pricing policy, while the local file contains detailed documentation about the specific transactions and transfer pricing policies relevant to the permanent establishment in that country. Now, step 4 is to do regular reviews and audits. Do regular health check. Now, it is critical to conduct periodic reviews of your enterprise transactions involving the permanent establishment to ensure that they continue to comply with transfer pricing regulations. Now, business operations evolve, and regular reviews help keep the documentation and pricing policies up to date. So you need to do that always. Conduct regular reviews of intercompany transactions. Now, after having conducted the regular review, the next thing to do is to perform internal audits. So internal audits should be conducted to verify that the transfer pricing policies are applied consistently and that the necessary documentation is in place. Internal audits can identify potential issues before they lead to tax disputes. Yes, it is a proactive approach of making sure that you can identify potential issues before they lead to tax disputes. Now, let's look at some case studies. Case studies on transfer pricing and permanent establishment. Now, let's look at some practical examples of how transfer pricing compliance is handled for permanent establishment in different jurisdictions. Case study 1, manufacturing and permanent establishment in Germany. Let's look at the overview. ABC Manufacturing Limited, a multinational company headquartered in the United States, establishes a manufacturing permanent establishment in Germany to produce components for related entities within the group. Now, like we said, the implementation will include, perform functional analysis. So the German permanent establishment is responsible for manufacturing and quality control, while the US headquarters oversees research and development and sales. Let's use that as an example. So, we've been able to look at that functional now. So the function performed by the German permanent establishment is manufacturing and quality control, while the function performed by the US headquarters is to oversee research and development and sales. Now, the second thing to look at is to look at the profit attribution. Profits are now attributed to the German permanent establishment, to German permanent establishment based on its manufacturing activities. Using the cost plus method, under this method, a markup is added to the cost of production to determine the arm's length. So you can see that, having attributed to the German permanent establishment based on the manufacturing activities, using cost plus method as the appropriate method. Now, under this method, a markup is added to the cost of production to determine the arm's length principle. Now, transfer pricing documentation that needs to be done, which is the third thing that they will implement. So, ABC Manufacturing Limited prepares detailed documentation, including functional analysis, benchmarking studies, to support the arm's length pricing of the transaction between the permanent establishment, which is in this case the German permanent establishment, and the headquarters in US and other related entities. Now, of course, we know the outcome of this because they are compliant. The comprehensive documentation and adherence to the arm's length principle ensure compliance with the German transfer pricing regulation. Now, on taxation, German taxes the profit attributable to the manufacturing activities of the permanent establishment. So the Germany taxes the profit attributable to the manufacturing activities of the permanent establishment, while the US also taxes the residual profit derived from research and development and sales activities. So that means the taxes were based on the activities, their functional analysis, and the core activities that they have performed. Now let's look at another case study too. Now sales permanent establishment in France. So we were using DEF Sales Limited, a multinational company headquartered in the UK, establishes a sales permanent establishment in France to manage its sales operations in the French market. Now, the first step, like we said, is to do the functional analysis. So the French permanent establishment is responsible for marketing, customer relationship management, and sales transactions, while the UK headquarters handles product development and strategic planning. Now, profits are attributed to the French permanent establishment based on its sales activities using the resale price method, where the resale price is reduced by an appropriate gross margin. Now, they also, need to prepare transfer pricing documentation. They need to document the functions performed, the risk assumed, and assets used by the French permanent establishment, along with their benchmarking studies to support the transfer prices. And the outcome will be compliance, because the thorough documentation and application of the arm's length principle ensures that the French permanent establishment complies with local transfer pricing rules. With respect to taxation, which is still the outcome, France taxes the profit attributable to the sales activities of the permanent establishment, while the UK, United Kingdom, taxes the remaining profits from product development and strategic planning. Let's look at another one, maybe in this case, the last case study. GHI Services Limited, a multinational company based in Australia, establishes a service permanent establishment in India to provide IT support services to its global operation. Now you can see that we've looked at the implication of a service PE. We've looked at implication of a sales PE2, and we've also looked at the implication of a manufacturing case study. So let me just go back to GHI Services Limited that actually did have a service PE in India. Now, functional analysis is the first step. The India permanent establishment provide IT support and maintenance services, while the Australian headquarters is responsible for strategic IT initiative and innovation. So you need to first of all identify what the functional analysis is all about. Then profit attribution. Profits are attributed to the Indian permanent establishment based on its IT support activity. You can see that it is the function that they have performed and the asset they've used and the risk that they've undertaken is what we are focusing here with respect to the India permanent establishment, which is on IT support services using the transactional net margin method. So that is the appropriate method that they've used. So this transactional net margin method compares the profit margin of the permanent establishment to that of independent companies providing similar services. With respect to transfer pricing documentation, GHI Services Limited prepares documentation detailing the functions, risk, and assets associated with the Indian permanent establishment, along with comparable data to justify the transfer prices. Now, the outcome, as usual, is that with the comprehensive documentation and the appropriate application of the TNMM method, ensure compliance with Indian transfer pricing regulations. And with respect to taxation, India taxes the profit attributable to the IT support services of the permanent establishment, while Australia taxes the residual profit from strategic IT activities. So that is the outcome of of that. So now, in conclusion, managing transfer pricing for permanent establishments requires a deep understanding of the functions, risk, and assets associated with the permanent establishment and the careful application of the arm's length principle. Now, compliance with local tax regulation is also very critical, as important profit attribution or inconsistent transfer pricing policies can lead to disputes and penalties. Through detailed functional analysis, accurate profit attribution based on the authorized OECD approach, and the maintenance of comprehensive documentation, companies can ensure compliance with transfer pricing regulations and avoid tax disputes with authorities. Now, these case studies provided today already highlight the practical approaches to achieving transfer pricing compliance in various jurisdiction, demonstrating the importance of robust documentation and consistent application of transfer pricing policies. Thank you for your attention.